Sandeep, I hope you are ready with your slides, a few slides on how the financial reporting studies, critical issues, they all need to be covered by fund givers and fund managers also. Without these insights, no a first person should give funds readily to anybody, and the fund manager should know each of these aspects. Every participant here should develop competencies to become a fund manager for his own money, for his family's money. And there we are, a few insights on various asset classes, part of the wealth management series. We have a series of participants, panelists in the popular think tank webinar series since over 10 years, conferences now in digital mode, different issues discussed at length, deep dive across the series, insights from all professionals, participants. I would also acknowledge the participation. Mr. Mitesh Parekh is here, partner with a top firm with the deep insights. Mr. Sunil Gedwani is here, deep insights, experience with top most professional firms in the world, Arthur Andersen, Pricewaterhouse, and deep dive, always ready, deep insights on functional areas. Sandeep, can we have
ready.
your
yeah, thank you.
please? Yeah, Sandeep, I would mention, has been always a permanent learner. He attended a course, a certificate course for financial planning and wealth management as a student, where I was addressing that conference on advanced financial planning and wealth management. Sandeep at that time mentioned to me he has experience with Aditya Birla Group at a very senior level. He has also been a CFO of CLSA, a UBS, ABN AMRO, and detailed insights as always continuous learner. We all are continuous learner and always ready to share deep knowledge. I would also mention Yogesh Satpute shared a few words. Chartered accountant and also ICAI, England and Wales, PhD also, and also program of IIM Ahmedabad, and person handling a very senior post in a top listed corporate in the Nifty. We have a lot of participants here. Sandeep, a few slides from you as a part of the wealth management series,
Sure.
always going on. And then we have an
Sure.
open house, all the participants, experts, people having domain knowledge or any question also.
Sure, sure. In fact, let me take you to what we had done actually. In terms of the contents, we had gone through some of the financial planning part, and then the disclaimer as always, because even if I speak out any forward-looking statements, you should not take it for granted that that's a thing which you should actually take and do something on trading or long-term investing. You should look at it yourself as well. Now, the last time we did was financial planning, and then we did one section of the asset class, which was the real estate. And we dealt in depth for the real estate sector. What I have here is the rest of it. Immediately, if you look at it, you have precious metals and antiques. Now, one of the things, again, when you look at, the last time I said, the presentation gives you an aspect where you're not actually going and investing in gold, for example, or silver, for example. But are there any things which you can substitute by investing in commodities or metals which replace these as physical? For example, you have, you can purchase shares of listed companies. For example, Titan and, Tribhuvan Bhimji Zaveri. Or you can actually have prices of listed stock. And these listed stocks are mining stocks which have very, very good credentials. Now, these are stocks listed in London, for example, Newmont, Newcrest. They have mines in Australia, Canada, Papua Guinea, New Guinea, etc. Then you can have actually go and invest in sovereign gold bonds. You need not actually go and invest in gold itself. One advantage where you would always have is the sovereign gold bonds are secure because it's issued by the RBI and the government of India backed as security. The second thing is it gives you an interest of 2.5% per annum. So that is the second thing. It is linked to the price of gold. So if that's my last slide, which I won't be taking it today, but if you look at the gold prices as well as prices of stocks, what will happen is, or what you have is, it is almost the same in terms of incremental value over a period of time. So what happens is, if you go and invest in a sovereign gold bonds, if you have a period of say 5 to 8 years as your outlook for gold, you can actually go and invest in the sovereign gold bonds. The other way around is you have ETFs, which you have where you can actually buy the ETFs for ICICI Pru or SBI or Nippon India or things of that sort. So it is not necessary that you should be buying physical gold. That's the most important thing. The second thing is valuation. Valuation, I think it's automatic. The ETFs and all are listed. Again, the gold companies are listed. All those, the valuations are there for you to take up. In terms of physical gold, even you have the prices of gold coming in on the local exchanges. So you have the price of gold as well, which can be, if you want to actually, you're holding gold, you can buy or sell gold in the physical form as well, depending on the prices. Now I go to the next one. On taxation, one should look at, and one important thing, which again I will tell you, an important aspect for sovereign gold bonds. They are exempt from capital gains if they are held to maturity, which is 8 years. So in addition to the 2.5% interest which you are earning, on maturity, whatever capital gains you gain are exempt from the taxes. Otherwise, the taxes, in fact, are under Section 54. This again is an interesting slide. I go to foreign currency. The last time I told you that, we can't do it because the sector itself for foreign currency, for example, are mostly done on the exchanges by huge fund managers, whether it is banks or the RBI or others. We as individuals may not be able to actually participate because our volumes are much lower, and it is risky to actually do a trade on the exchange. I know that it's allowed from the NSE point of view, where you can actually do forward for the exchange on the currency market, but it is very risky, because unless you know the movements of the prices of currencies, I wouldn't advise anyone to do it, and all will be taken up by the banks as well as the RBI, or for example the mutual funds as well. So that's one aspect. What can we do as individuals for investing in foreign currency? There are two aspects. One is the aspect where I'm taking the last item here, which is called LRS, which is the Liberalized Remittance Scheme, under which you have 250,000 US dollars, which can be invested abroad every year. So it is not only in terms of assets, whatever asset class you have, depending on the restrictions of the foreign land. So that is a caveat. So based on that, you can actually go and invest in that foreign country. So it can be the US share market, or any other markets which allow you to trade on those exchanges. There are brokers who allow trading. In fact, there is HDFC Bank, Motilal Oswal, and others who have, allowed you to trade by opening an account on the foreign exchange, to trade on the foreign exchange markets. The other way of looking at it is there are mutual funds which invest only in the foreign, or rather not only, but in a mixed way. It's a hybrid fund where part of the investment is in the local market, part of the investment, a percentage of it is invested in the foreign markets. For example, I think it is Parag Parikh, which invests in the US NASDAQ. And I think that's one of the best, mutual fund, I would say, which is in the limelight right now because they have invested in a lot of FANG stocks. So they've made a lot of money in that. So that's an investment. Now in this, the presentation which was made, I have also given out the links to the RBI circulars. If I press this, it'll go to the RBI circulars, and it'll give you all the terms and conditions on which you can invest in those markets. So that's an advantage where you can go to the RBI circulars, and if Manoj, I think some of these slides where there are links to the internet, these slides could probably be shared with the participants. So this is where it says what is the liberalized scheme, what are the prohibitions, and so on. Then you have under FEMA, who can open an account under the FEMA rules. And this is the questionnaire under Section 2.5 of the FEMA Act. You can open up a resident foreign currency account and utilize the amount. Then the other question which comes up regularly, and you are actually holding currency. For example, you go out on business trips, or you actually go out for travel, tourism. How much are you allowed to actually carry to a foreign country? Those are different rules again, and this first one is the amount which is there. The answer to the first one was you can actually have $2,000 equivalent for retaining after you come back in foreign currency. Then the other thing is, how much can you take when you go out? It is 10,000 per person. So these are some of the aspects which are there in foreign currency, in terms of an individual. Foreign currency as a trading aspect, right now it is very difficult for us to actually do it. But if your relatives are out there in a foreign country, and if you want to maybe at a future date settle abroad, this is one good aspect where you can actually start planning in advance. If you think that the dollar is going to go up, or the Australian dollar is going to go up, and you are likely to go to Australia, for example, in the next 2 or 3 years to settle down there, it is quite possible that you start, transferring amounts to that country so that you benefit from your foreign currency, holding. So instead of holding Indian rupees here, you can actually make a gain by holding the Australian dollar. Now, this is something which is known to everyone, and this is of interest to each and every one. Again, here I'm likely to take in the future sessions on fundamental analysis and lessons on technical analysis. So, the point I'm trying to make is I'll not be going into the depth of this, but all I'm trying to say here is, first of all, what are equity shares? Equity shares, everyone knows, for private limited companies or listed companies, you know what a DRHP is. I don't have to go through that. The only aspects which are there is, the ADRs and the GDRs which are possible, and in relation to some of the aspects, the possibility of actually going out to the foreign markets and issuing shares. I think the government is allowing, and it's quite possible Flipkart might be the first to go and get listed outside of India. Possibly in the next 2 years is what Walmart has you know put it in the papers actually. So I don't want to be guessing when it will come in, but that's something which is possible for listing. Now, in fundamental analysis, um, all the ratios which, as a chartered accountant, I don't have to tell you all what ratios mean what, but just to be on the important aspect of ratios under the current conditions and under the conditions where um, you have an investment in a company. In addition to all the ratios, I think what is essential for you to make out, this is very, very important. And that is the net cash which is generated per annum. That is number one. What is the cash on hand of a particular company? And this was very, very important when the COVID struck us. This is something where the IT companies, for example, or the FMCG companies who were sitting on a lot of cash gained because they were defensive, because they had cash for their operations. Other companies were dependent on borrowings. So apart from all the other ratios, I would say the operating ratio, for example, or positive cash flows in a particular capital or particular year is something which is very, very important. So as I said, I'll come to the ratios, the fundamental analysis. And again, what is beta? What is, how do you actually evaluate, calculate those things? I will take it up in other sessions. Just to be on the page here, fundamental analysis is one where you can estimate future prices, what you should be doing in terms of holding a particular stock. You have to calculate the intrinsic value of a particular stock. That again, how to calculate, I'll come up in the next session. But based on the intrinsic value of a particular stock, you can either invest if the prices of that stock is lower than the intrinsic value, or sell it if the intrinsic value is lower than the actual price of that stock. So that is what fundamental teaches you. Fundamental analysis teaches you. In terms of technical analysis, it's completely different. Technical analysis is based on prices for the past, or what is called historical past prices. They are based on demand and supply for a particular stock. So all I can tell you, or rather in a very brief way, is the manner in which you can actually look at technical analysis from the point of view of the market. When you are making a higher top or a higher bottom, that is where you are assured that the prices might still go up further. But when the situation reverses, when the markets tend to turn around and then you have a lower top and a lower bottom, the markets could turn in the short term and the markets could head lower. So that is one of the things which I would like to tell you even before we get into the depth of what technical analysis is. Then in technical analysis, you have what is called the intraday or closing charts. You have the bar charts, you have the candlesticks, and also we have what is called the Heikin-Ashi charts. You also have what is called the oscillators, which is very, very important. There are more than 50 oscillators which you can actually look at, and based on which you can estimate where exactly you are in terms of whether you're in an overbought position, oversold position, or you're in between and you're in a no man's land. But some other oscillators might help you to actually gauge the movement of the stocks in the future. So it has to be a collective decision on how the stock market movements will take place based on oscillators. As I said, the higher top or higher bottom. The other thing which is always there is the candlesticks charts or the Heikin-Ashi charts. You have also called what is called the patterns. You have different patterns which are there in the technical analysis. These patterns, whether it is a triangle, whether it is a rectangle, whether it's a head and shoulder pattern or an inverted head and shoulder pattern, all these allow you to actually calculate where the market is heading. So if there is a breakout for a triangle, for example, on the upper side, you can estimate the price of where the the prices of a particular stock are heading. So that again, I'll come to it in the next sessions. The most important point is, people compare fundamental analysis and technical analysis. It's very difficult to actually know, except where you have a very big strategy team, for example, and an economist is doing his work. It is very difficult for those guys to have everything, in one place. That is, you have the markets where you learn how stocks movement would be, how commodities move, how the metals move, how the currencies move. But in technical analysis, it would hardly take you a day to actually read all of these and make out what would be the future of the markets. Be aware that it would take you about 3 to 4 hours per stock or a particular, indices or a particular commodity. So it takes, it is not a very easy thing where you look at the chart and you will be able to make out how and where the stock movement will be. It could take 3 to 4 hours. But what I'm trying to say is, it is much easier from the technical point of view to ascertain the movement of the entire gamut of stocks and movement of other commodities, etc.
Can I request Manoj to take it ahead?
Sorry?
No. Okay. Sandeep, you're done and left out.
No, I got logged off actually. I don't know why.
Okay. You still continue. That will be good.
Yeah, I'll just continue. Yeah, so I've come to the equities. The other thing which, I'm sorry, I got logged out. I don't know how, but possibly the network. The other aspect, other than equities, is the debt market, where you have mostly you would have the banks which deal on the debt market. You also have mutual funds for the debt market. So it is always better for us to actually go through that route while investing in the debt markets. That for the mutual funds, I will come to a different I'll take it up in the next session again. I don't want to be going through it right now. In alternative investment funds, which is what we call AIFs, and which is also called private equity, what we have is three categories of investment vehicles which can be done. One is the first, which is a very easy thing, which is a small scale in nature, where you have the venture capital funds, the infrastructure funds, angel funds, and the social welfare funds or social venture funds. Category 2 involves private equity for a longer duration, debt funds, and fund of funds. Category 3 is the only one which allows you, dabbling in futures and, in terms of the futures market. You can hedge your positions, and there can be private investment in a public equity fund. So there can be pipe transactions, as what we call it, pipe transactions in the third category of funds. So there is an underlying problem here that the amount of investments which need to be made in a particular fund in terms of alternative investments is a sum of rupees 1 crore. So as an investor, you need to actually invest a minimum of 1 crore and look at the particular the investment fund, the venture capital fund. You'll have to analyze it, which sectors they can invest. There is what is called the PPM, which is made out like an offer document. You need to go through it before you actually invest in a private equity or a venture capital fund. So which sector? In terms of valuations, you all know how a valuation is done for the debt as well as for the equity markets. We have the multiples, you have the book values, and on top of that, for a private equity or a venture capital fund, there is normally what is called the discounted cash flows, which are made out, and you have average it out, and you have what you have is the valuation which can be done for a particular company which has been invested by a particular private equity fund. Suppose a private equity fund invests in a private limited company. These three methodologies would be worked out to ascertain what is the value of a company in which that private equity fund has invested, so that the NAV can be derived at for the venture capital fund as a whole. Capital gains, you again all know. In terms of the debt funds, you have, I'm talking in very briefly, you have the government bonds or safe money market instruments. You have treasury bills, certificate of deposits or the commercial paper, corporate bonds or non-convertible debentures. Trading securities, you bifurcate in, and I think the best example would be in banks. You are actually required to have the bifurcation of trading securities and securities available for sale. So these are some things which should be noted. Those people who work in a bank would know it better. So at the initial stage itself, when a particular security is bought, you need to actually say whether you have to identify which bucket it will go through. And depending on the bucket, the valuation is done at the end of a particular period. So it will be mark to market when you have the trading securities. So if you are holding it to maturity, for example, you don't have to, the unrealized gains are excluded from the reporting. The securities are, traded on what is called the NDS, and settlement is done through the settlement system, security settlement system. I think that's what I have got for your for y'all for today, because the next sessions which are there would be much longer, and those will include, but again there'll be two sessions. One is technical analysis and one will be fundamental analysis. Thank you.
Thanks so much, Sandeep. That was really great insight you have shared. We look forward for your sessions which are coming up, and since you mentioned about the technical thing, most of the people will be interested about the technicality of how things move, and we have seen it in the past when you explained it to us. That was great. Uh, uh, we will open it up for question answer in case anyone has any question. We have all the panelists here. They are here to answer all any questions or doubt what you have. Hand it over to everyone.
We have lots of questions on the chat also. A few important questions. Mr. Mitesh Parekh has raised some issues. Mitesh?
Yeah, Manojji.
Yeah, can you just put your video on? And I'm glad you raised very practical issues. We will surely take it up and discuss. Just put your video on. Some interesting things on metals, IT, etc.
Correct. So there are some stocks in the IT which are based out in the Nasdaq. There are some mining or metal stocks which are sitting in the Canada or maybe in Houston, or say even to that extent Australia. So can a person trade in respective exchanges? That is point one. Now the government, it's a little tax side question. The second one, the government has brought in 2.5% tax if there is any remittance which is happening. So is there any benefit which I get in my capital gains, or if you have any clue on the taxation front? And there will be again a double taxation or treaty again, that will be case to case basis, it will vary. And once I sell the shares, so the money is coming in, will I get that rebate of 2.5% which government has withhold, or how it is just treated as one-sided?
Very good issues raised, Mitesh. I would like to address some core issues. You talked about investing in metals and minerals. There are two parts to it. In fact, every investor can have the opportunity. One is buy the stocks on the exchanges, whether domestic or global. Another is metals and minerals. Also, one can participate in the opportunity by way of participating in registered, recognized commodity exchanges also. Like gold is a metal. There is huge trading in gold. There is investment in gold also in sovereign bonds, where there is such an interest amount also payable to that. And on investing in stocks of metals and minerals, one can invest in mining stocks, one can invest in value-added stocks, and also one can take advantage of local exchanges, domestic exchanges, international exchanges. Also, we have an offshore exchange gift also. And there are now stockbrokers in India. They open offices in India. Within one day, they open an account with you. So you can buy any stock on a global exchanges like Dow, Nasdaq, international exchanges. That opportunity is open. Earlier, it used to take 1 week to 2 weeks to open an account. Now that account can be opened within one day, and you can start trading subject to limits. There were foreign brokers registered in India who were earlier requesting you to start with $10,000. Now there are domestic brokers also with tie-ups with international brokers. You can invest in a few shares of international stocks, whether it is metals, whether it is minerals, or whether it is IT, or it is any stock, or it is ETF. Also, there is opportunity provided through mutual funds who have part of the allocation to global stocks. It was mentioned here about the Parag Parekh Value Fund, which has exposure to international stocks like Google and Apple too.
Correct.
And there are many more funds which are coming in. with exposure to international stocks, but one has to keep in mind the fund managers' mutual fund fees, which are quite significant. And direct exposure is also there. It is also there with discount brokers who charge very nominal brokerage now in a very competitive environment. So opportunities are there. The idea is to have exposure and have value addition and buy at the right price based on your risk level. There was another question here also, can you recommend some stock to buy? As we always say, it is always good to know which stock to buy, which stock to sell, what level to buy, what level to sell. But as we always share in such sessions, there is a opportunity to learn the models and the techniques and the know-how to know on what basis to buy and how to ascertain the levels. Levels could be ascertained by way of intrinsic value, as Sandeep shared, how to look at the intrinsic value, or the models of technical analysis. There are different models by different experts, and there are different theories. But the models and the charts give insight to understand. And based on that, if one can combine the technical knowledge, fundamental knowledge, financial reporting knowledge, deep dive into the various sectors, understand and interact with the sector and domain experts, that is the best way forward. But keep your risk in mind and keep the disclaimers in mind, and also always keep the vested interest of the person recommending the sector or the stock, his level of knowledge or his limitations in mind. That is very, very crucial. So deep dive is encouraged. Go deep into it. It is your money, your family's money, maybe your client's money, your investors' money. It is very, very crucial to learn to deep dive, and it's a dynamic world. Markets are also dynamic. We have seen fluctuations in 2020, just the Nifty levels of 7,000 plus odd and 13,000 plus odd. It's almost 90% change. In many stocks, there is a change of 300%, 400% also. So one needs to go into deep dive, look at the financial reports, look at the annual reports, look at the quarterly results, look at the disclosures, look at the insider selling, look at the disclosures, look at the presentations made. There's a lot of transparency happening because of the governance structure. There are con call transcripts. There is access to directors, access to the CEOs, access to the IR. Get to know that and understand the models which are being discussed, sharing of insights by experts like you in your own domain knowledge. There are many experts and CFOs, CXOs, CEOs always ready to share the knowledge. So that's it, Sandeep. Would like you to add your views?
No, so I think for the income tax question, I think somebody else will have to answer that question on the remittance, the 2.5%, whether it can be adjusted. I believe it should be adjustable because the question was for investing, right? Rather than.
So one is with regards to investment. So whether that adjustment also when I sell can be considered for my capital gain as cost of acquisition, or that will be taken out separately. And second is whether I can get any compo for my income tax liability.
Mitesh, I can address that. This is a new development. And there is e-filing now and also faceless assessment. And the assessing authority may take its own view. So there is no clear thing on this or any judgment so far from the assessment angle. But based on the provisions of the income tax for capital gains or for business income, depending on an investor, one can claim all the cost of acquisition of the capital asset. That is very clear. What is the cost of acquisition of the capital asset? That should be claimed. And if it is business income, then all the cost to earn that income should be claimed. And let the assessing officer take his view. But it is very, very clear under capital gains, the cost of acquisition of the asset is allowed to be claimed while arriving at the net capital gain. Then also there are lots of benefits of capital gains, whether they are short term or long term, or reinvestment or the proceeds. One should take all the benefits very, very clearly. And I would like to share, there is a series of think tank webinars ahead where specific tax planning issues would also be addressed and considered, whether it is tax planning through mutual funds or directly through capital gains planning or business planning. And also there are different issues in tax in PMS and mutual funds, and directly also we have to ensure there is a post-tax return. As Warren Buffett always used to say, in value investing, he looks at the post-tax return very, very clearly. So investors should keep, as you mentioned, the post-tax return in mind on an annual basis, on a compounded basis, year to year. Of course, one should keep the cash flows in mind, and one should take the risk factors in mind. Some investors like to sell at a good price and then re-enter at a lower price. Then they have to pay the tax, depends on the level of tax they are. And internationally, because in this think tank webinars, we address international issues based on the residence profile of the investor and his residential status. There are different benefits available. And there are double tax treaties also, and benefits through treaties also for assessments of citizens in various countries. In fact, we have a tax expert here. I mentioned about Mr. Sunil, and he is always ready to share his views post-tax and also deep knowledge about offshore exchanges and offshore markets.
Thank you.
There happens to be one more question, Sandeep, from Mr. Umesh Devadiga. He is trying to ask me, what's the rationale for the Nifty and the BSE are reaching new all-time high when the economy is at the ground level at different level? Like, you know, what is your view on that?
The view is very clear. In fact, see, there are two things which have happened. One is the inflow of funds from abroad. The stimulus which has been given out by foreign, the foreign governments, whether it is the EU, whether it is China, whether it is the US. The money has come in, more than 60,000 crores has come in. And that's surely gone to the markets. The other thing which you should look at, there is one more thing which, if you have really focused on, the amount of net inflow is not that much. From the point of view of the markets, there is an outflow from the point of view of the debt funds. Okay, so whatever amounts have gone into the equity funds, almost 10,000, there's a 10,000 crore difference between the inflow of the equity funds and the debt funds. So people have actually withdrawn money from the debt funds and put it in the mutual array to the equity funds. That's number one. Number two, if you see, people have been looking at the FY22 results rather than what is happening. Everyone has been imagining things on what is going to happen on the vaccines. The vaccines have already come in, and I think in 2 or 3 quarters things are going to change immediately, and that is what I said. People are looking at FY22 rather than the present. In terms of governments, yes, the governments are in a deep spot of bother. Companies have benefited because, one, I already told you, because of the inflows. Second, companies have benefited because of the low interest rates. You see each and every company, their interest costs have come down substantially. And that is one more thing which is happening. Interest rates on even to the public for example, for whether you want to purchase a vehicle, whether you want to actually go and buy a house, the rate of interest for housing is come down to 6.75%. Kotak gives it at 6.75%. So demand for housing also has gone up. With the impact of that, the real estate stocks have moved up for the last few months. So it's automatic. So as a whole, the problem is there from the point of view of the country as a whole on the macroeconomic scenario, but from the point of view of micro, I'm talking of larger companies, mind you. I'm not talking of MSMEs. The problems on MSMEs will be evident in January onwards, based on the fact that you have the moratorium. What is the impact of the moratorium once that is removed? Those will be known in the coming months. But the problem is the listed stocks, the stocks which have enough liquidity, I don't think that has been a problem. What will be a problem will be the MSMEs.
Thank you, Sandeep. I would like to add the crucial issue of question on Nifty and BSE. Market always looks at the future. It's very, very clear. What is the ground reality and the future? Today, the ground reality, there is a opening up, and the latest numbers show good growth in industrial production, also the core sectors also. And then we are looking at the growth numbers of current and future. There is a latest expert opinions which are mentioning the growth for 2021 will be over 8%, could be 9 to 10% also. So market discounts the future earnings and the growth. Another thing is the global fund managers, they have a habit to look at various quantitative models and the projected earnings for forward years. The projected earnings as per the topmost research brokers are showing, they look at FY22 earnings, and based on FY22 earnings, the Nifty earnings are just about 21, and earnings are growing because of the current year. There has been very good learnings by the corporate sector. The cost structures have come down substantially.
Yeah.
And the reduction in cost structures is not temporary, it is permanent. They would again add to cost, but in different models. So fixed costs have come down, variable costs have come down, rentals have come down. So there is huge opportunity when the revenue increases month to month, quarter to quarter. Then many companies are saying they would like to have higher EBITDA margins. Of course, it is based on a competitive scenario. And I would just mention, looking at a chat, one of the participants with deep knowledge about the markets has mentioned it is not only FII flows, the retail demat account numbers have increased heavily by more than 1 crore. Many first timers. So huge number of retail investors are opening accounts. They have been sitting at home and they have tasted money. Suddenly, so much information is available in the social media. Different models are available. Different research reports are available. So they have tasted money. And the recent IPO, which just closed last this week, there is collection of over 1 lakh crores in FMCG IPO. And Burger King happened last week. That was very good returns on listing.
Yeah.
The Bector's IPO, the collection is over 1 lakh crores, and the participation by retail investors is just amazing. Whether it is a QIP or the leverage investor or the NBFCs who make huge money by lending for a very short period to investors, huge subscriptions, and people are looking at listing gains. They are looking at their risk also. But we would suggest, please look at the risk factor. Don't just look at the listing gains, but huge opportunities. Money is coming all over to emerging markets. India is one of the emerging markets. Other emerging markets have also gone up significantly, particularly in the last 2 months. huge money is coming to emerging markets because there are various currency issues also. So people look at the net return in the foreign currency. So very good returns, and people look at the recent earnings, recent money made also last few days, and how it is forward looking. The forecast by some of the topmost research houses going forward, this shows the indices may cross all-time highs. Of course, indices are dynamic, they are changing continuously. It's really wonderful. Dushyant Shah is here. He has keen interest in capital markets. Dushyant, can you share your insights?
No, rather, I wanted to ask you something. That's why, I put on the mic.
Always, always welcome.
Yeah, see, the thing is, what Sandeep has said is true. Because, now a lot of people are trying to... Yeah, a lot of people are trying to, figure out why the market is, going up for last couple of months or so. And without doubt, it is the FII fund flows, which are really, taking up the market. But then the question is, how long? Because
it's very simple. How long? It depends on as long as the money keeps coming to the sectors and stocks, and the earnings keep on improving. So then it should continue. And there is huge FDI also coming, manufacturing, PLI coming. So there is huge capex also coming. Investment cycles are being changed. Business models are being changed.
no,
So
but
there is huge potential in India.
yeah, that's
Huge potential. Not only that, if you are looking at global markets, there is huge potential in emerging markets.
but within
Oh, the more the money comes in, there will be huge increase in the productivity also, hopefully, and also growth, and money flows goes where good risk-adjusted returns are there. Of course, people talk about corrections. Corrections are there on a daily basis. So there are corrections in different stocks, different sectors, different indices. But there is opportunity ahead because of the huge potential of the market, huge potential of the whole demographic advantage also. So volatility, make it your friend and try to understand volatility. If there's a correction comes or a dive comes, better you do a deep dive yourself into sectors and stocks to buy and continue enriching your knowledge and everybody's knowledge in the think tank webinar series.
Dushyant bhai, let me
wire copy.
I think there is somebody cross-talking or, mic is not unmuted. Yes, Sandeep.
Yeah, hi. Dushyant bhai, my practical experience in the market, because I've worked in FII broking houses, and this is some, insight from what happens. During the month of November and December, unallocated cash flows, which are there with funds abroad, they tend to come into India, or what is called unallocated. So that is number one. Number two is January and February, there are new allocations. So they tend to come into India again. So this is the period when, so it depends on where the markets are, and depending on where the markets are, the funds tend to come into India or go out. If the markets are very, very, high, then they tend to go out. But then if you see, naturally, the amount of money which comes into the Indian markets or the emerging markets always come in during November, December, January, and February. So this is the, practical insight of the things which have been there over the past few years or past many years.
Yeah, but then sometimes, they have to book profits also before December. Say like, their accounting year from January to December. But that thing has not happened here.
Yep, people, that's the reason why we said markets are future, looking, and people are looking at a higher position in FY22, and that's the reason people are holding on to it. So the money is still coming in. So there could be as Manoj said, there could be a correction, but the outlook is still positive.
I would like to add a large amount of profit booking by foreign fund managers who get their bonuses based on profit booking has already happened to a substantial extent.
Okay.
And they are reinvesting in different stocks and different sectors, and they don't want to convert into higher percentage of cash because they foresee a good ride ahead based on the minister's policies, reforms, and investor friendly and investment friendly policies coming, because we need to grab the maximum share of pie of the money available. Huge money is going into Brazil, Turkey, Russia, huge money. In fact, the percentage rise in other emerging market countries is much more than India in the last month. So there is huge potential, and fund managers don't want to miss on the upside. So they want to remain in the equities. Latest numbers also show foreign investors are converting from bonds to equities, because bond they look at the adjusted returns in currency, and equities are outperforming as an asset class compared to other asset classes. Even the allocation to Bitcoin by funds who are permitted to invest in Bitcoins is also increasing, because that has also given good returns and there is good potential ahead.
Right. With this, I would like it's around 1:45. Still, we're having a lot of participants still there, but we know it's a lunchtime. I would like to convey the thanks on behalf of the Think Group to all the speakers today: Rajesh ji, Santosh, Sandeep, Manali, and all the participants who have really participated very hard, full-heartedly discussing all aspects which are there. And well, I would like to inform you all that the next session, what we have planned for 26th, that's going to be a much more seminar on wealth management, where we're going to talk about the analytic understanding and as well as a part on technical also. So with this, anything, Manoj, anybody like to add anything, or we try to say goodbye to all?
Thank you very much, and thank all the participants. Wonderful sharing by all, and I was really glad to see many authors of books also sharing their insights. We have a very eminent author also. We had a couple of eminent authors of books. I hope we'll be having excellent sessions, and they would continue participating, and we'll have more knowledge sharing. So have a
we look forward you all to be there. We look forward you all to be there in our next sessions, and we would like to inform you that we are there on YouTube. So we'd like you to subscribe to our Think Tank webinars, as well as I would like you to like our various seminars which we have put over, the videos which have been made. Thank you all. Have a good day to all.
Yeah, thank you.
Thank you very much.
Thank you.